Hello traders, Corey Mitchell here of TradeThatSwing.com. In this video, once again, I'm going to look through some price action, this time from the perspective of what's called negative information, or what didn't happen is sometimes as telling as what did happen. I'm going to read a little passage here from, this is The Daily Laws by Robert Greene, great book. As are all his books. So this is March 26th, kind of the thought for the day. Pay attention to negative cues. In Arthur Conan Doyle's story Silver Blaze, Sherlock Holmes solves a crime by paying attention to what did not happen. The family dog had not barked. This meant that the murderer must have been someone the dog knew. What this story illustrates is how the average person does not generally pay attention to what we shall call negative cues. What should have happened, but did not. It is our natural tendency to fixate on positive information, to notice only what we can see and hear. It takes a creative type, such as Holmes, to think more broadly and rigorously, pondering the missing information in an event, visualizing this absence as easily as they can see the presence of something. So what the hell does that have to do with trading? If you've read on TradeThatSwing.com, if you type in the search box false breakouts, there's an article on false breakouts. And basically a false breakout is kind of this idea of a negative cue. We expect something to happen, and when it doesn't, that tells us as much of what we need to know as if it did happen. We have a very clear choppy trading going on here, and we can see this price dips below it, moves back up in, and you'd think if this was a breakout, this should, kind of hold here and keep going. Now, that's depending on also my beliefs and my strategy. But when I look at this, it's like this should go. The fact that it gets up here and then we start getting triggers back up in the old range, that tells me that what should have happened didn't happen. So now I'm looking for the opposite, basically. And this is going long. So we've talked in prior videos about key levels and combining those to capture higher probability trades. And one of the things that surrounds that topic is this idea of negative cues. Does what happens around those levels, is it actually happening or does it not happen? And you can see I've kind of segmented off some price. We could go through loads of examples where this is relevant, but we'll limit it to this kind of price action here. So this is our first one, where the breakout that could have, and of course nothing should happen in the market, but we started to break out and it didn't happen. That's as good information as if it did happen, because it's going to provide the same opportunity. Whether this holds outside and keeps dropping, then we have a breakout opportunity. If it doesn't go and we start getting triggers inside the old range, that also potentially gives us an opportunity to go long, in this case with targets up near the top of the range. So now the same thing happens up here again. This time we don't get a trigger inside though. We move up, we get the pullback, and right on the line there. If you went short there, I wouldn't have too much of an issue with that. We were trying to break out and couldn't. But you would get out of that trade, your stop loss would be hit anyway, and you would potentially go long here when what we were expecting does end up happening. All right, so at this point right here, you do have the possibility that that tried to go up. We've had our pullback. We're getting a trigger down in this range. It's not quite as clear as this one. You can see the candles fully inside the range on this one, whereas this one, we're kind of right on the line. When we get that red candle dropping below that candle, showing us, hey, maybe there's a possibility of a false breakout. What was supposed to happen, the move to the upside, isn't happening. Could get a rollover to the downside. But then when this basically reaffirms that it's going long. So we've talked also in prior videos about how how price is dynamic. Just because we come up with an idea or we have this concept where it's like, oh, it broke, it's failing, it's got to go down, it doesn't have to do anything. Price is dynamic. If it doesn't drop, then anyone who is thinking it's dropped is now trapped. They're going to start buying. We have this run up. Now, we could analyze all this, but what I want to look at is this here. So we have actually a pretty decent size pullback here. I'm just going to draw a line on it to show how big it is. So we have this bigger drop, and then we have a pullback. Now, if we're just looking at what should happen, we'd kind of expect, a similar size drop, which would take us down here. The fact that this stalls out so quickly right at that low and then reverses to the upside tells us something. What didn't happen tells us as much as what should have happened. Nice, some pretty strong selling coming in. Yeah, now obviously the bigger trend still up, but we had some nice selling coming in, and then it stalls out. So what is this telling us? This is telling us that the sellers lost steam relative to this prior drop. Again, some negative information. What should have happened didn't happen, and that tells us a lot. You could make this into a strategy, this sort of pullback that fizzles out, right? So you have a bigger drop, you have a pullback, and then it stalls out on the next drop. You could turn that into a strategy because it is information. Although typically we would wait for, at least if you've taken my courses, I'll usually wait for the rounded bottom, something like that. So we have the drop, pullback, drop to a slightly lower low, move up above this pullback high, we have a higher swing low, and we get the move to the upside. Right, so that's our little rounded bottom. What I call a rounded bottom continuation because the overall trend is up. We're getting a rounded bottom, which signals the end of a pullback, and as opposed to the end of a trend where it would be downtrend, then we get a big rounded bottom and it moves to the upside. It was moving to the upside. The pullback rounds out and goes to the upside. And then the last one we'll talk about is this. So we get in here thinking, okay, we have our rounded bottom, we're going up. We have a recent high right here. If this uptrend's to continue, we would think we'd uptrends, higher highs, higher lows, we'll just base it kind of on those simple concepts. So if this is going to turn into an uptrend, we would want to see those higher swing highs, higher swing lows. The fact that it stalls out right there, and then actually whether we went short or not, I wouldn't go short here, but it does provide a trigger to the downside, right? We stalled out and then we start going below candle lows to the downside. So if it's an uptrend, what should have happened is we should have moved strongly to the upside. That's why we're taking the trade. We're thinking, okay, this is gonna move to the upside. So we can look to the negative information, what doesn't happen, to also give us clues. This doesn't move up as strongly as I would want. It gets stuck right at that prior high and then triggers to the downside. So this is a little bit more advanced concept where you could look at reasons to get out of trades because they're not doing what you want. So I do have rules for this. I don't always just put out a target and a stop loss. You definitely could do that. But we could also look at the information that's coming in as the trade unfolds, because as I've talked about, markets are dynamic. They are changing. If the price doesn't move up when a lot of people think it should, they are now trapped and it moves back the other way. So this is an example where a lot of traders who went long in here are now starting to feel pretty trapped if this drops. And we couldn't clear that high. And now we're triggering, just like we were doing over here, we're now kind of, if you view this as a little range, we're now triggering back. We're back inside this old high and we're triggering to the downside. So kind of a similar concept. I would say this is a much more key level because it's, a big range. Lots of people were involved. In this little price area, there's a lot less people that are involved as there were over this 3 hour or 2.5 hour range. but the concept is still there. What should have happened didn't, and that gives us information that, maybe I'll get out of this and then wait for something else, wait for it to do what I want or what I expect, and stick with those trades that are doing what we want, what we expect, as opposed to the trades that are not. So incorporate it if you want negative information, and yeah, hopefully that helps you out. If you find it too confusing and you're doing okay without it, that's totally fine too. But if you find it helpful, look for the negative information.